Hello everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today we're going to go ahead and make sure that you know why velocity banking works, how velocity banking works, and we're going to make sure that we're paying off all of our auto loans, right? Especially the ones that are $25,000, $30,000 in way less time than what the dealer wants you to. Listen, we're going to make sure that all of our home loans are paid off in way less time than what the bank wants you to. Why? Because we have velocity banking and we know what to do with it. Before we get into it, like, share, and subscribe so that the power of velocity banking can be shared with the whole world and they can be free too. Now, let's get into it. Before we get in to paying off this auto loan, I want to share with you the 4 pillars of velocity banking. I think it's very important that we share with you the framework of why velocity banking works. Okay, so we're going to start with ULI. That's understanding loan inefficiency. All right, you have seen the cash flow indicator and why we actually use that formula. The reason being, we want to get rid of the most cash flow sucking loans, those inefficient loans, the quickest. So they are our priority. In velocity banking principles, all this is going to let us know is we have to make sure that we're using velocity banking tools the wisest and most prudent way, whether that's the line of credit, whether that's our checking account, savings account, whatever account it is, we got to make sure that the money that is in there is not staying stagnant. Okay, we've got to make sure that it rotates. We got to make sure that it is deployed to different war zones, right? Different war loans, okay? To make sure those loans are paid off so that we don't get bit by the interest, okay? Then we have SDD. What in the world is that? Strategic debt. That's right, strategic debt deployment. So a lot of people consider the line of credit a debt. Okay, you and I know it's not. Okay, the line of credit can be used to make sure that what we're doing, what we have, right, that's staying stagnant, that isn't getting used, because a lot of you have lines of credit that aren't getting used, right? But you have loans up the yin yang. Does that make sense to you, right? We're going to use that money, right, that is unsecured or secured, and we're going to deploy it toward the loans. But we have to do that in a strategic way. We're going to go over all of that, okay? And then FFWB, what is that? Financial freedom and wealth building. Well, after you have eliminated your debt, guess what? You're still at ground zero. Now is the time to start using the lines of credit and the loans, not for cars, right? Not for consumables, but this time for assets. Can you imagine if you're able to pay off all of your loans that were for consumables? Can you imagine when someone else is paying your loans each and every month? I'm telling you, it's awesome. So let's get into how we pay off this car loan. But guess what we have? We got a competitor. We got a 5% car loan. At the same amount, $25,000. Now, we see on the CFI, the cash flow indicator score, that they have a 53. Okay? We have the 5% loan here, and the 10% loan is represented up here. Okay? The cash flow indicator for the 10% loan is, of course, going to be inefficient. Why is that? Well, look, it's a higher percentage rate. And many of the time, you have a lower credit score. What does that mean? A higher interest rate. That's okay. We're going to show you how those that are at the 10% interest rate can actually fare better than those that are at the 5% interest rate. Maybe you got a 600 credit score, and the 5%ers, well, they got a 700, maybe an 800 credit score. They're perfect. We're going to show you how to get out of the loans way faster than these guys, all right? So look, what are we going to do, all right? We have the inefficiency score of 0 to 50. We understand that this auto loan scores a 53. What does that mean? Well, the 53 is above the 50, meaning, well, you are in the caution zone and you can refinance, you can restructure, you can call and perhaps get an even lower, right, interest rate. And so those are your options. And I think that's the best option for someone that does not want to use the velocity banking method, and they have 800 or 700 credit score, and they have the 5% on their auto loan, all right? But what we're going to use as velocity bankers is our checking account or our line of credit. Here in this scenario, we have our line of credit, which is at 21% interest, and there's $10,000 in there. What do we do with the $10,000? Okay, let's say it's unsecured. What do you do with it? You just got free money. Are you just going to let it sit there? Are you going to use it for consumables? Or are you going to use it to pay off this pesky loan? After all, you've got it at the 10%. So this is what you do, okay? You've got the balance of $10,000 on your line of credit because guess what? You were buying J's with it, you were buying Y's with it, you were buying all these consumables, and that's okay. Because you make $5,000 in income and $3,000 is the expenses, okay? This includes your monthly payment. The cash flow is $2,000. Can anyone tell me when you're going to get out of this line of credit? When you're going to zero out this balance? 5 months. Why 5 months? Because line balance divided by the cash flow equals your velocity term. Now, I've got to say this. Miss C, amortized. Let's give you the definition of amortized right now, okay? Amortized, when we say amortized, we mean there's no way you can pay all kinds to the principal, but you're not going to change that payment. It's going to be, let's just take this one, $571 a month, regardless of how you pay off that principal, okay? When we know that the line of credit is not that way. That's what we mean by amortized. That's why it's got the word to kill in it. Did you know mort means death, right? The death is you. They're trying to kill you with how they calculate those payments, all right? And so thank you so much. That was a very, very good question. That's what we mean by amortized. Now, $571, that's what regular people do. We are not regular people. We're going to go ahead and pay this off in 5 months, okay? Then we're going to go ahead and get us a car that's worth the $25,000, and then we deploy the $10,000 towards that $25,000. Why? Because that automatically jumps us ahead, or that's called a time collapse transaction, where we are months and months, sometimes 16, 17, 20 months ahead of schedule in paying off this auto loan. And so the first month we are at 10K, we deploy that 10K, now we're at 15K, all right? Why? Because 25 minus 10 is 15. Now, remember, you're deploying the 10,000 towards the principal to take out that interest. Isn't that beautiful? So 5 months goes along, right? And you're still paying the $571 each and every month. I said you're still paying the $571 each and every month, all right? And then on the 5th month, guess what? You've replenished your 10,000 that you just deployed on the 1st month. So what are you going to do with it? We're going to R&D it, okay? We're going to replenish and deploy on the 5th month another 10,000. Isn't that exciting? Now, of course, you're going to be paying $571 each month until the other 5th month, which is 10 months in all. Then you're going to be paying and deploying the 5,000. Why is that? Well, because we have it, number one, and because we want to capture the cash flow. And we just paid off our vehicle in 10 months instead of 6 years. You see, this person is still paying that $471 each and every month, while we are not paying that anymore. And that $571, right? We were $100 each month. We were more than those with 5%. But now our $571 is going down here to our cash flow and making it $2,571. Why? Because we understand velocity banking. Why? Because we understand that when you're using velocity banking, 10% is less than 5%. If you have any questions or you need some answers on your particular scenario, please don't hesitate. Get with us. We want to see where you're at and we want to show you where you're going, okay? Because you may have a level, right, that is down here. We want to make sure that we are meeting you and closing that gap so that what you want becomes a reality to you, all right? We want to do a time collapse transaction for your banking account so that you know how to implement this second nature. Does that make sense? Did that help you out? All right. So folks, if you have any questions, please don't hesitate. Oh, by the way, if you're looking to see, wow, which one saved on interest, we still saved on interest, even with the 10%, right? Because remember, this person is still paying for the 6 years. Isn't that wild? Now, there was somebody that said, hey, CJ, you're actually going to be paying it off way less than the 10 months. And I thank you so much for that. You're actually going to be paying it off because you didn't calculate in there the monthly payments that were going towards the principal. I know. That's how powerful velocity banking is. I could over-calculate. I could do it, right? Because these numbers, they're way more than the actual numbers. Way more. This right here is way more than the actual number. The actual number here, after paying $571 a month, is going to be less than, what's it, 15K? Okay? Your balance is way less. But I did it way more just so you could see the power of velocity banking. Folks, if you have any questions, don't hesitate. Get with me. Make a call with me. Make sure that you get in our class, enroll in our class so that you can get that customized debt elimination plan and know velocity banking like the backside of your hand. God bless you and have a good night.